Hi, my name is Andrew Rocco, and this is my Finance 451 project of investment analysis. I'm going to be analyzing two different industries with 5 companies each in each industry. I've picked electronic gaming and sports apparel as two industries to analyze. The companies I've picked are Activision, Electronic Arts, Take-Two, HubSpot, and Zynga for gaming, and Nike, Adidas, Columbia, Under Armour, and Deckers for sports apparel. In the gaming, Activision is a video game publisher best known for titles like World of Warcraft and Call of Duty. They merged with Blizzard a few years back and became bigger than they were. EA develops, publishes, and distributes games for console, PC, and mobile devices. They're very well known for their video game, for their sports game like Madden. Take-Two, game developer responsible for the Grand Theft Auto series, also own 2K games. HubSpot, inbound marketing firm that has a presence in the social gaming industry. And what inbound marketing is marketing that's much more narrowly targeted through the uses of social media like videos and blogs and podcasts and video games to the target market. And Zynga, which is a provider of social video game services. First, we want to look at their short-term solvency ratios to see how liquid they were and if they were liquid enough. And as you can see, Zynga was by far the most liquid as far as the cash ratio was concerned, up to 4 times more liquid than the other companies in the fiscal year 2015. Other than that, across the board, it was really between 1.2 and 2 as far as the cash ratio went for the other companies. With the current ratio, again, mostly the same story with Zynga out in front and the other companies kind of clustered in the middle behind them. The quick ratio, Zynga once again at 4.52 in fiscal year 2015, and the other companies hovering between 0.96 and 0.142. Then we want to look at their long-term solvency. We're concerned about how much debt they have to pay off in the long run. Activision and Take-Two have by far the most debt. Take-Two has almost 4 times as much debt as EA, according to fiscal year 2015, and HubSpot and Zynga sport nearly zeros in their long-term debt over the past couple of years. Looking at their equity multiplier, because we're interested in the leverage that they have. Leverage magnifies gains and magnifies losses, so we want to be able to tell if the good numbers are being driven by a lot of debt. Across the board, not too much debt. 2014, HubSpot did have 6 times the other competitors, but it kind of normalized in 2015 with the highest one being 2.95. Now we want to look at profitability ratios. It's return on assets, return on equity, and profit margin. We want to see how efficient these companies are at using assets given to them by stockholders or by creditors. Activision, positive ROE, positive ROA in the last 4 years. Their profit margins have been relatively high, and ROE has been pretty consistent. EA has seen a huge spike in ROE the last 2 years, going up 18 times what it was in 2014 over 2015. ROA experienced a similar leap, and the profit margin shot up as well. 2014 was a down year for EA as far as profitability ratios were concerned, but they certainly rebounded in 2015. Take-Two, you see a lot of volatility. You see negative 17 in 2012 and negative 42 in 2015 as concerned with ROE, but in 2014 had the highest we've seen so far, 52.74. HubSpot didn't have a lot of profitability ratios available, but as you can see, 2015 was not a good year for them as far as profitability ratios go. Negative 39.63 with ROE and as low as negative 25.87 with profit margin. Zynga, mostly negative throughout the last 4 years. They were slightly positive with ROE and ROA in 2013, but still were losing money on the profit margin. Next, we're going to look at economic value added, which is going to be the difference between the net operating income after taxes minus the capital charge. And Take Two is well above the rest of the field, with Zynga bringing up the rear. Market to book and the price to earnings ratio. You can use the price to earnings ratio to see what the market thinks the company is going to do with the earnings. Overall, across the board, nothing jumps out too much except for EA's PE ratio for 2015, which is 234.16. It's almost as high as Zynga's PE ratio of 2014, but the other companies are definitely lagging behind in this area. What do analysts say? Activision, they recommended a buy. Based on their profitability ratios, I agree. They've been consistent. They've been steady. I think it's a safe, sound investment. EA, they recommend a buy. I don't know if the spike last year in profit margin is sustainable. I would say hold. Take Two, recommend to buy. I'm concerned about the size of their debt to equity ratio. I'm not sure if they have enough cash flows to cover that debt long term. I would recommend a hold. HubSpot, analysts say buy, and I agree. Zynga, they recommend a hold, and I would agree. So what I thought was the best company in gaming was EA. It has enough cash, not too much debt, the industry average leverage, and their future looks bright. There's high expectations based on the PE ratio of what we think EA is going to do in the future. And that's why I think it's the best company in gaming. Now we'll take a look at the sportswear industry. First off, there's Nike with the swoosh. They design and develop shoes for sports and other accessories. Adidas is the second largest sportswear manufacturer in the world. Columbia is a company that manufactures and distributes outerwear and sportswear. Under Armour is sports clothing and accessories company, and Deckers is a footwear designer and distributor. We're going to take a look at their short-term ratios once again. And with their cash ratio, every company is pretty similar across the board. Adidas keeps a lower cash ratio typically than the other companies. It never going over 0.5. Under Armour also stays pretty low. With the current ratio, Columbia is a little bit higher here. Deckers is the highest in 2015, with Adidas still bringing up the rear at 1.4. So Adidas has so far been the least liquid. And that trend continues in looking at the quick ratio. Adidas is 0.67 in 2015. And Deckers is once again the most liquid at 2.20 for this last fiscal year. Look at their long-term solvency. Check out their total debt to equity ratio. Under Armour has the most debt to equity. Adidas is right behind them. Under Armour concerns me because their debt has doubled in the past. Their debt to equity has doubled in the past year. Adidas was already kind of trending high and going up consistently. Columbia and Deckers both have very low total debt to equity ratios. Look at their equity multiplier and see what kind of leverage they have. Not surprisingly, Adidas, which had the highest total debt to equity ratio, also have the highest equity multiplier. Leverage magnifies gains and losses, so we'll see if that's reflected in their profitability ratios. And we'll take a look at those right now, which again is return on assets, return on equity, and the profit margin. Nike, the profitability measures for 2015, they had an ROE of 27.82, which was the highest in the industry. They had an ROA of 16.26, which was about 6 higher than the industry average, and they had a profit margin of 10.7. And for this industry, the average ROE for this year was 16.63. Adidas also did well, but not as well as Nike. ROE was 13.05. The ROA was 5.72, and the profit margin was 4.36. I'm a little surprised to see them underperforming Nike, even though their equity multiplier was higher. And then there's Columbia. Their measures for 2015, the ROE was 12.45, the ROA was 9.36, and the profit margin was 7.3. Under Armour, their ROE was 15.70, their ROA was 9.57, and their profit margin was 5.98 for the fiscal year 2015. Deckers had an ROE of 14.13, an ROA of 10.5, which is right at industry average, and a profit margin of 7.16. Let's take a look at economic value added, and as you can see, Nike has blown everyone out the water in this category with an EVA approaching 2,000, and it looks like no one is even approaching 500 as far as the other four companies go for the fiscal year 2015. We'll take a look at the market to book ratios and the PE ratios because we can see what the market expects them to do the next year. And the numbers that stand out to me are Under Armour in 2014, they had a PE ratio of 82.36. 2015, that only went up 92.78. The high number concerns me a little because if expectations are already that high, I'm not sure how much growth is actually available for this company. What do the analysts say? Nike, analysts recommend to buy. Based on their overall financial strength, I would agree. Adidas, analysts recommend a hold because they're below industry averages of ROE and ROA, and I agree. Columbia, a buy is recommended. It has the highest short-term ratios in the industry. I would also recommend a buy. I wouldn't be concerned about them being unable to repay their debts in the short term. Under Armour, analysts recommend a strong buy. I'm concerned about their huge increase in debt, although their PE ratio skyrocketed as well. I would downgrade strong buy to buy. Deckers, analysts are leaning towards a hold, 2.7 instead of a 3. They have the second lowest total debt to equity ratio in the industry and have adequate short-term solvency to cover it. I would say buy. I think the best company in sportswear is Nike. Their profitability measures are above average. They're not tied down with too much debt. I think they're more flexible than other companies. And they have the highest EVA in the industry. So they had the highest difference between the net operating profit after taxes and their capital charge. My final conclusion is that Nike is the best company to invest in. The market expects good things as evidenced by above average PE ratio, and Nike had the highest ROE and EVA in the industry. And that's our presentation. Thank you.